Hello and welcome. You're watching the Global Reset with me, Prashant Nair, on CNBC TV18 Prime. This is the program where we try and connect the dots between geopolitics, markets, and economies. Lined up on the show today, we're going to be speaking with Sean Darby, who is the equity strategist at Mizuho Securities. He's a market veteran, and he writes widely on economies, economics, markets, industry trends, and much, much more. But before we go across to our guest in just a bit from now, let me get you up to speed with what has happened and transpired over the weekend. A lot has. Now, the U.S. celebrated their Independence Day on the 4th of July. That was also the day the U.S. President Donald Trump signed his mega tax bill, which, of course, is described as the one big, beautiful bill, into law. The bill fulfills two of Trump's key signature policies, making the 2017 Jobs Act permanent, as well as introducing several new tax breaks, including those paid on tips and overtime. However, even as the bill was signed, many Americans and economists especially voiced concerns about the landmark policy, citing its costs and potential impact on lower-income people, etc. So a lot of critics out there as well. Meanwhile, another headline that has global markets in wait-and-watch mode is President Donald Trump's tariff announcement. The U.S. president has said he has signed several letters detailing the tariff rates the countries would face on goods exported to the U.S., describing them as, quote, take it or leave it, end of quote, offers. Donald Trump has said that the letters would be sent out on Monday, that is today, later today. Later, he took to Truth Social, the social media platform, to add that countries aligning themselves with the, quote, anti-American policies, end of quote, of BRICS will be charged an additional 10% tariff.
Sending letters out on Monday having to do with the trade deals. It could be 12, maybe 15. Secretary of Commerce right here. And I guess, Howard, I would say it could be maybe as many as 15 or so. And they'll be going out on Monday, and some will go out on Tuesday and Wednesday, and we've made deals also. So we're going to have a combination of letters, and some deals have been made.
Well, the U.S. Commerce Secretary, who was alongside the U.S. President, also told reporters that the higher tariffs would take effect on the 1st of August. Listen in.
Tariffs go into effect August 1st, but the president is setting the rates and the deals right now. Well, the president is right in the midst of discussing all sorts of deals with all sorts of countries, and the gentleman to my right is going to decide, and I'm going to be with him when he makes that decision.
I think we really have to look at the texts that ultimately come out, because even last week we had announcement around the US-Vietnam deal, but it doesn't seem to be really the final word. We don't have the final text yet. And with trade agreements, a lot of it is about the fine print, right? And so it's very hard to say exactly where we are at this point. I do think that the new deadline suggests that the administration is giving itself a bit more time just to get some of these agreements over the line, because some of them seem to be stuck. I mean, we've been talking with Japan for all these weeks, and yet we can't get it over the line. So I think there's a bit of wiggle room. But also, I'm struck, equity markets are just shaking it off. I mean, you look at the Japan market, right? It's just, equity markets don't seem to be bothered by all of this. On the fiscal side, we probably now have a bill. We kind of know where we're going. It's not great in terms of fiscal dynamics, but at least we know we can put it under models and kind of discount it and so forth. On the trade stuff, you're right. I mean, it's not 200%, 150%, but it's still very substantial. And when we hear that things could go back to April 2nd, remember that was a trigger for a major sell-off. And yet the suggestion that we could go back to that seems investors to leave them completely unimpressed. But I do wonder whether we're a bit too confident going into the next few weeks, because there's a lot that could happen. Not necessarily on a global scale, but with individual economies. There might be some economies get picked on, quote unquote, suddenly coming with much higher tariffs than expected, and that would have an impact on the growth trajectory.
That was Frederick Newman, Chief Economist at HSBC. Well, joining us now is Sean Darby, Equity Strategist at Mizuho Securities. Sean, of course, is a long-time watcher of markets. Sean, great to be speaking with you here on the program once again. Thank you very much for joining us.
Good afternoon. Thank you very much for having me on the show.
Sean, is the ninth? I don't think markets ever believed that the ninth was a sacrosanct red line kind of a date. I mean, there was always this presumed flexibility because it was self-imposed in the first place, and the expectation was that the administration would be more pragmatic, at least with countries it sees, deals being made, maybe with a little bit more time. Is that the right way to look at it?
I think so. I think the markets have essentially discounted a global 10% baseline import tariff from the United States. So that's really a given, and I don't think anybody is going to escape that. Even Singapore, which runs a US a deficit on its trade with the United States, is facing that baseline. So that's the first thing the markets have been sort of comfortable with and essentially discounting. I think the degree to which the Vietnam deal showed how far the reciprocal tariffs can drop under negotiation to 20% overall gives the market some comfort that we're not going to get those escalations which have so damaged market sentiment back in April. I think the worry is that you may get these idiosyncratic trade points that are very, very specific to countries. And you could see that in the text for Vietnam, for example, in which transshipments from China are going to be tariffed at a very, very high rate. Similarly, for countries like Japan and to some extent South Korea, the auto tariffs may be a very, very specific negotiating point. So I think the dynamics are that we'll get a 10% baseline with some headroom above that. But for certain countries, and specifically North Asia ex-China, I think it's going to be a much more difficult period because clearly they've been negotiating for some time and they're still unable to get any resolution with the United States.
Even here in India, Sean, I mean, what we're picking up from sources is that there could be like a mini trade deal, but again, a decision whether to go ahead with it or not is going to be taken in the next 24 hours, maybe 48 hours or so. That's what we kind of sort of pick up, really. This August 1st, when the tariffs go into effect, how would you see it? I mean, just near term from a market standpoint, not that markets are very worried, but is that effectively kind of sort of pushing it forward, giving space?
It is a little bit. I think the markets have benefited from a very, very substantial reflation trade. So if you were to take out the tariffs for a moment and just look at where the dollar has dropped, which is over 11% on a trade-weighted basis from its peak since January, you've had oil prices which have generally headed lower over the last year. And virtually every country put in some form of fiscal expansion going into the tariff shock and hasn't actually withdrawn it at all. So in reality, you've had a very, very big reflation trade that's been playing itself out across global markets, and the tariff, in some respects, tariff discussions have to some extent been a nuisance because, in all other things being equal, you would have expected economies to show quite strong growth going into 2026.
Yeah, no, absolutely. I got that. Sean, the just one quick bit, the transshipment and what we saw with Vietnam, right? It's a bit puzzling, isn't it? I mean, getting goods from one country, labeling them as your own goods and then selling them and exporting them is illegal in any case. This seems to suggest, I mean, if you're making something in Vietnam and the raw materials of, say, for example, come from elsewhere, say from China, I think that's the target here, then there is this tariff, this 40%, which is going to be imposed. And that may well be the template for other ASEAN economies, you think?
I do actually. I think it's a way that stops, or from the United States point of view, stops China circumventing the rules. And certainly there's been evidence in the last couple of months that the relabeling, which is, I guess, what the other way to look at transshipment tariffs, have been part of China's maneuvering around the tariff rules. I think for ASEAN, you're going to find them with all of them facing the same sort of hurdle. And I would imagine one of the really big tariff negotiations, which is with Mexico, Mexico will also face that as well. So as I say, there are nuances to some of these trade deals, which are designed specifically to ensure that there is no cheating by China. But transshipment one has not been given as much focus on in terms of the news headlines, but it's one that certainly will affect ASEAN, and presumably the big one will be Mexico as well.
No, absolutely. Point taken. Sean, just one more quick point with China. I mean, if you were to rate sort of tensions between U.S. China, I mean, are they rising? Are they falling? Are they static? I mean, just how would you
Mm.
how would you rate in terms of where we are?
I guess on a year-on-year basis, things have still increased in terms of geopolitical tensions, is the way I look at it in the whole spectrum. There's been some deals which have been better than expected, which was, of course, the software announcement for exports last week, and some deals that have been done from China's side on rare earth metals. But I think the way I look at it is that there's a trade war, which is China's part of that as well as most global economies, and there's a technology war, which is really a specifically China-US issue, and those are the way it is really the way the markets are going to focus on things going forward. Those two dynamics are really what's going to affect equities. So you could get these, as I said, idiosyncratic shock announcements on technology which have bear no relationship with what's been happening on the trade side. And I think that's going to be what the equity markets are going to face, under the Trump administration going forward.
Got that. Sean, in your last note, you said, well, you are going long international equities versus the U.S. So explain that. I mean, the U.S. market, I mean, the S&P 500, for example, hit a new all-time high on that holiday shortened session on Thursday. It's been quite a run from the lows in April. So when you say you are long international equities, you're reducing exposure U.S. and going long elsewhere. What are you recommending?
So the rub of it is that you're going to expect decent nominal GDP from the United States going forward, and we tend to look at nominal numbers given the inflation rates in the United States and elsewhere. However, the advantage that the rest of the world has at the moment is relatively low bond yields. So there's not the dynamics are ones in which these economies still have room to expand. And certainly, I would actually expect the US to pace of growth to pick up quite considerably now, because the text in the United States is very much geared from the tax cuts towards spending. Accelerated depreciation is a big bonus for corporates in the United States under the tax deal. So the economy in the United States might do very well, but the S&P itself might find itself constrained simply because real bond yields in the United States don't have much room to maneuver. And again, we could be seeing real bond yields of about 2%, and that would, I think, make it life a little bit more difficult for the S&P despite a reasonably decent economy. Elsewhere, global markets have relatively low bond yields, and there's quite a lot of room for equity multiple expansion.
This and yields. Where are you seeing them, Sean, in the U.S.? I mean, the 10-year.
So I think we could, under the type of scenario in which Mr. Powell sort of is replaced, and we get much higher levels of inflation, I think we'll see 10 years back up to 4.6, 4.7 again towards the end of this year, early next year. That's the way I'd look at it in terms of the expansion of the economy. I think people look at the tips and overtime tax changes, but the really big one, I think, is the impact on spending for corporates. That accelerated depreciation is really a huge bonus for companies to spend up front. And this is a if you really want an economy to expand, one of the ways to do it is to allow companies to write off their expenditure within 1 year. And I think the US is probably going to have a mini corporate capex boom. So again, 10-year yields might actually pick up quite quickly.
Sean, you said if the Fed chair is replaced, his term only officially expires, I think, in May of 2026. Are you saying we'll see change before that?
No, what I would suggest is that there will be ongoing pressure for the
Okay.
Fed to cut rates, and just we had that same rhetoric and narrative in April, which again upset bond markets. It fell quiet through May, and by late June again we've seen the same temperature rising within the Fed. I think the key here is that it's difficult for the U.S. Trump administration to believe that they're fiscally expanding whilst at the same time the central bank is doing quantitative tightening. It's almost undoing the very work that they believe that they're trying to ensure makes a strong economy. So there's going to be continued pressure on Fed Chairperson Powell, I think, right up until the end of his term, and the rhetoric is going to be towards cutting and easing monetary policy.
We'll take a quick commercial break here. Sean, stay with us. What we also will do, of course, is turn our attention to what you like, which is international equities. India, of course, is a bet for you as well. We'll talk about that. Stay tuned. Welcome back to CNBC TV18 Prime. You're with us on the Global Reset. We're still in conversation with Sean Darby, equity strategist at Mizuho Securities. Sean, good to speak to you. You know, we sort of covered a whole bit before we went into that commercial break. Let's come to what you like in international equities. So, and I'll go into details with regards to India, but India is clearly a bullish bet for you. What else?
The good thing about international equities at the moment is that the various equity markets most of them are experiencing, like India, disinflation booms. So the emerging markets, including India, which historically had difficulties in controlling their inflation rates, have got better inflation rates now than the United States. So I think there's a separation going on with international equities, particularly emerging markets, in which these central banks, for the first time in modern history, are cutting rates despite the Federal Reserve being on hold. So that dislocation, I think, works well for emerging markets as an asset class, and that includes India. On the other side of the coin is Japan, where we're now seeing a 2.5 decades of deflation being swapped for quite a strong inflationary pulse that's underwritten by wage increases. So corporates now have a much better pricing power. If you're looking at service inflation in Japan, it's between 3 to 4%. And that means that there's a corporate profit cycle which is not necessarily dependent on yen weakness. So that also is quite good for international investors. You're playing a theme in Japan which is not necessarily revolves around exports and the depreciation of the yen. I think overall for Europe, the cohesion politically of Europe at the moment has been one of the key standouts. If you've looked in the past, there was always internal divisions by the weaker nations in the south versus the much more stronger nations in continental Europe. That's almost disappeared, as well as unemployment. Unemployment levels now in Europe have been much, much more sanguine than we've had over the last 20 years. So again, Europe is on a different set of dynamics than people would have expected, coming into COVID. So in general, global equities outside of the United States are actually in reasonable health, irrespective of some of the tariff problems that we've alluded to a little bit earlier on.
Okay, let's come to India, Sean. You like the market, and I was looking at your last note, which came out right after what the RBI did, and really front-loading a lot of cuts. There have been tax cuts in the union budget as well. There is this hope that consumption, it's like being the boy who cried wolf as far as consumption is concerned. But maybe now it'll finally pick up, about time. What makes you like the market here? There is, of course, as you said, disinflation, which is a trend here. But the common complaint in India has been it's always an expensive market, and you know it, Sean.
So I think there's been a couple of dynamics which have made the story a little bit different than what we've seen in the past decade. I think the RBI has won a lot of plaudits for keeping policy tight and controlling inflation. So yes, they did do the 50 basis point cuts, but it came after a period in which they really did ensure that the inflation genie wasn't going to come out of the bottle. I think there's two or three other things in at least in the short run that are sort of pro-Indian equities. One is that historically, when you've had cuts in the cash reserve ratio, that's generally preceded a decent credit cycle. So I think again that would fit into the theme of the consumer. Secondly, the balance of payments has tended to be much better, and ironically, there's a very close correlation between the performance of the sensex and FX reserves. So again, that fits very nicely into the Indian story at the moment. And last but not least, I think when you've had periods when Indian small caps have done well, it's been a very strong indicator for the broader market to perform well as well. There's, in small cap and large cap tend to be, dynamically correlated, and that performance in small caps over the last couple of weeks, I think, presages a pretty good sign that there's going to be a decent rebound in growth going into 2026 and presumably 2027 as well.
Small caps and mid caps is the area which you think will do best here in India, Sean.
I do. In fact, I think it probably is a theme that might start to play itself out globally. Small caps have had a terrible period of underperformance versus large caps globally. In fact, small cap value has been a really atrocious area to have been invested in. But the dynamics of the cycle now for emerging markets, in which you have this rate cutting cycle, which is very different from anything we've seen in the past two or three decades, means that there's a lot more sensitivity for small caps to perform as those real interest rates come down. And I think, again, India may be the lead indicator for the rest of the small cap emerging market stocks.
And I mean, here in India, though, Sean, I have to say that small caps have had no such problems. Unlike, for example, in the US, where the Russell has lagged. Here, of course, it's been boom, both for mid and small caps, relative to large caps over the last many years. But you think they should continue to do well. And I think in that report, you do mention close correlation with interest rates, the CRR cut.
Yes, I think that I think you've underwritten the performance of the Sensex and the small caps because you look through the last decade or so. There's no real history where the small caps and the Sensex have actually performed poorly. So the cash reserve cuts were, I think, slightly overlooked when we saw the headline cut by the RBI of 50 basis points. But that's really the dynamic for the economy is the cash reserve ratio cuts. And I think, again, it's going to presage a decent period of growth for 26.
Any sectors which you think will do well here?
We've continued to like the banks. I think the real income story in India has still a further to go. So we've been encouraged by that, and we also feel that we are going to start to see some of this reflation globally, coming back into some of the prices of metal stocks and so forth. And I'm a big advocate of the whole expenditure cycles on military, etc., all feeding into the industrials. So banks, industrials, and some of the consumer discretionary in India, I think will do pretty well in the next 12 or so months.
Sean, great conversation. Thank you very much for joining us. And as I was telling you earlier, I hope this is the first of many here on CNBC TV18 Prime. Thank you very much.
Thank you.
Okay, well, as we wrap up on this edition of the program, let's also listen in to Claudio Piron, Head of Asia Forex and Rate Strategy at Bank of America Global Research. He shared his views on the India-US trade deal, where the rupee, he thinks, is headed, and whether the end of dollar dominance is even a trend. Listen in.
So far, the communications and the signaling both from the White House and from New Delhi have been quite positive. I think they're both very interested and engaged in getting a deal over the line. So I think amongst all the countries that are in the negotiations at the moment, they're in the envious spot of being in a good relationship. So I think no, and there's no need necessarily to rock the boat. The Indian rupee has been lagging a little bit behind, and on that tweet headline, it kind of softened marginally. So I think we could definitely trade stronger. If you look at some of the fundamentals that India has been achieving, best current account in over 18 months, very solid deficit of the current account, less than 1%, FX reserves back to 700 billion, inflation at 2.2%. What is there not to like? Yet the currency's kind of underperformed. So I think we could see a move nicely to 84 over the next coming months, assuming the whole world is moving in the right direction. The posture of a lot of Asian countries, India included, which had the balance of payments crisis in '91 and so forth, was always to be very defensive about capital inflows and always to be very, very concerned that they don't want a financial crisis. And then we had the Asian financial crises. I think we're starting to drop that, partly because we've matured. We've got higher levels of FX reserves in the region. We've got good local domestic bond markets, which means that there's less dependency on foreign borrowing, which means that people can actually relax a little bit about capital flow. And finally, why aren't we doing more cross-border settlement, which is only natural because intra-regional trade is picking up and becoming more and more substantive. So I see it in that context as being more of a normalization in the posture rather than being a posture towards being aggressively towards de-dollarization. And I don't think, particularly in the current climate, that would be in the interests and the view of Indian policymakers.